Good day, everyone, and welcome. My name is Dan Sampaio, and I'm delighted to open today's Mondac webinar in association with Croke, Fairchild, Morgan & Berez, Farrer & Co, and Veritas Partners. We are joined by a wonderful panel to take us through today's discussion. Neil McNamara is co-founder of Veritas Partners, with a particular emphasis and expertise in carve-outs, divestitures, and IPOs. Neil has supported private equity firms and corporations across the ownership lifecycle for more than 20 years. Jeffrey Morgan is a founding partner of Croke, Fairchild, Morgan & Berez. He serves as lead counsel for M&A transactions for many public and private companies and private equity firms. He also serves as lead counsel for public offerings of equity and debt. He also counsels boards of directors on corporate governance and internal investigations. And completing today's panel is Simon Ward. Simon is a partner in the Farrer & Co corporate team. His focus is on private capital and providing advice to clients on investing their capital in corporate and alternative asset classes. Before I hand over to the panel, a housekeeping item. You are able to submit questions to today's panel by typing them into the questions pane on the toolbar on the right-hand side of your page. Please do send in your questions at any time, and we'll try to answer as many as possible during our Q&A at the end of today's session. Any that don't get answered will be sent on to the panel, who will be in touch. It's now my pleasure to hand you over to Jeff, Neil, and Simon to begin. Thank you very much.
Dan, thank you very much indeed. And Neil and Jeffrey, welcome, and welcome to the attendees as well. What we just thought we'd start with before we get into the detail is just an overview, so you can navigate your way through the presentation, both on this session and through the slides afterwards. What we have done to facilitate this discussion is to split the session into two parts. Part one will be led by Neil, giving us the M&A and corporate overview, both within globally, US and UK, and both Jeffrey and myself will come in as well with some input. And then into part two, we're going to swap it around a bit, and you're going to hear from the lawyers, myself and Jeffrey, on deal execution and specific legal issues. We'll then share some final thoughts with you, and for the purpose of the slides, we've also just included some notes at the back in the appendix. So if we move on to part one. And on to the next slide. What we're going to cover here is deal activity last year, and any sort of guidance from that for the rest of this year, based on the first quarter, as we actually to the day are on the 31st of March. Part of that will look at active sectors and industry, and we'll also just pull down some deal data, and we'll steer through that with Neil's input. So, turning to part one and some of the data. Neil, just as a sort of first question, just to kind of get this discussion open, what have you seen in the way of deal activity up until today, up until during quarter one, compared to last year, and what can we learn from that?
Sure. So I think what we've seen, what we don't obviously have all the data to dig into this, but at least anecdotally, what we're seeing in the market is that Q1 still remained very strong on the back of what was just an amazing 2021 for M&A activity. I think unprecedented, really, in many ways, and that's obviously impacted us here on the panel in significant ways, as well as probably many that are listening and participating in the webinar today. So it remains strong. It'll be interesting to see when the actual statistics come out what the volumes were, but it didn't seem as if anybody was really slowing down, even despite some of the some of the global events that you would expect would drive it down, and maybe that will follow. But Q1 has been tremendously strong, and again, on the back of what I think anybody listening to this webinar knows, that 2021 was just simply unprecedented in this market.
And Neil, is there anything you want to sort of pull out in terms of data for last year? I mean, just looking in terms of what's on our screens, it's pretty incredible, as you say, the sort of the values of volume.
Right. It's like it was just across the board, right? It's you can't necessarily. I mean, obviously some industries were more active than others, but really, when you step back and look at it, just everything was up, and everything was up dramatically. And that really just it seemed to again crush everybody in this industry. If you have any friends that are investment bankers, you probably didn't spend a lot of time with them outside of the office, the last 6 months of last year. Anybody in professional services as well that's servicing deals, it was about as busy as I've ever seen in my career. And so that was, and again, across every industry, every environment, especially in the U.S. And I know the U.S. again, relatively speaking, was also quite again a big driver of the global growth. I guess that would be the one thing that I guess I would point out is that I think the U.S. was a big piece of this, but it was all industries, it was corporates, it was private equity, everything was slammed last year.
And just moving on to the next slide. Could I, Jeffrey, also get your input as Neil says, as the lawyer on this, in terms of what your experiences were last year? I mean, there's some impressive data here coming from the US.
No, I think Neil's exactly right. I mean, it was a banner year. A couple of things that I think we see playing into that are the very, very low interest rate environment, which is leading a lot of deals with a leverage, a leverage component to them. So we are seeing deals, being done with more debt financing maybe than they had been in years past. And I think the SPAC boom, and there are some ups and downs to that, including proposed rules out yesterday by the U.S. Securities and Exchange Commission. But SPACs were very popular in 2020. Then the volume dropped off, sort of at the end and into 2021. Still was a big volume. And one of the things I think we're seeing there are maybe the healthier SPACs, the ones where the sponsors have more industry expertise. So they have a more surgical, approach to what kind of targets they're looking for, rather than some that are just sometimes referred to as celebrity SPACs, or others that raise a lot of money with no particular direction which way to go. I think we're seeing as the sponsors of the SPACs have industry expertise and are looking for very specific targets, those are the ones that are getting done a little more frequently now. We'll talk when we get to execution. We'll talk about the proposed rules yesterday by the Securities and Exchange Commission. But so I think all of that has really led a big boom. I think there also was some uncertainty as to what the corporate tax rates were going to be under the Biden administration, and maybe last year there was a push to get some deals done because of the uncertainty as to where that is going to land. That uncertainty still exists, so it's still an open question for us. But I think those overall are the sort of some of the specific U.S. components.
And Jeff, one thing just to add to that on the SPAC, because this was a conversation I was literally having yesterday, that I think will continue to drive. I don't think we will see as many SPACs. I don't think we'll see as many IPOs this year. That would be a prediction that I would have, and I think we're already seeing a dip in the first quarter, just pure play IPOs. Again, back to the point, I think the ones that we will see will be more focused, solid businesses. But the other potential driver that's going to continue this on the SPACs is that these SPACs, they, like a private equity fund, they've got to put money to work. They've got to go do acquisitions, and there are even some that, to your point, Jeff, maybe more targeted, focused on an industry, doing better. But I'm also seeing those that started off more targeted, broaden it out a little bit, and all of a sudden start looking at, because they got to do the deals. And so whereas they might have been, narrowly focused on, maybe it's like an ESG play, now they're looking at other, at other again, they're just getting broader there because they got to do some deals. So I think that will help continue this trend because they've got to do them here despite the economic conditions.
I agree. And when we get back into execution, I mean, this is going to get into how bidders are trying to distinguish themselves to get a preemptive seat at the table, whether it's through, rep and warranty insurance or through other things. But I think you're right. People have a lot of money and they've got to do something with it. They have people expecting returns. There are the time pressures and the SPAC. So I think you're exactly right.
And actually just thinking about through and sort of types of buyer or types of active buyer and their kind of demographic, if you like, if we move on to the next slide and just talk a bit more about the private equity and how they're kind of assessing when to come into a process and what's driving that. Neil, do you want to just sort of start with some opening thoughts there?
Sure. So, as the first point, right? Record amounts of dry powder. So to the point I made earlier on the SPACs, they've got to do deals. So deals are going to get done. There's going to be a tremendous amount of volume still from the private equity funds. Current low interest rates, obviously that's with recent news here that's going to change over time. So again, I'll be interested in with what the Fed has released. Again, how that will impact this. But again, near term, not big enough changes that they're gonna change that these deals have to get done. They're gonna get done. I do think though, and what we have seen is that the private equity funds are being a little more deliberate in where they're going after deals. So looking for more targeted processes versus major processes and digging in where they think they've got a better chance of being the winner there and spending more time on those deals versus lots of time on lots of deals.
And I think you're exactly right. I mean, there is only so much capital, intellectual capital, that PE firms can devote to the due diligence or the consideration process, and they're beginning to say, we're not going to spend this one maybe has less of a chance of success, so we're not going to even invest the time in going through the preliminary due diligence. Similarly, I think investment banks that are brokering these deals, at least some of our clients we're seeing, are going to more specific specific groups of potential buyers rather than sending it out to 20 or 30. It's a more it's a more focused group of potential buyers they're going to in the first place.
Yeah, to pile on that point on the investment banks, the investment banks that we see that are doing a very good job in this environment are the ones that really understand the buyer universe and can advise their clients well on who to be bringing in the process and bringing the right buyers to the table, and more focused and targeted versus versus the volume and the shotgun approach of just trying to get as many people involved in the auction as possible.
And I guess in terms of the if you like, the sort of purpose or the topic of this session was very much kind of global as against local issues. Is it kind of important to have, if you like, kind of feet on the ground and actually knowing your market, particularly as you just said there, in terms of the fact that you are looking at a smaller group of potential bidders. It's very much knowing who's doing what.
Yes.
And we should also, if we flip to the next slide, Simon, get your input too from the UK side of activity, what you're seeing there.
Yeah, I mean, a sort of reason I was kind of asking the question actually, because we've sort of talked about the kind of global activity last year, the US activity. What's really kind of been positive and of course sort of negative is the fact that the kind of domestic capital, I suppose, you've got in the US is we've got some of that, but just the number of inbound deals coming into the UK, based particularly kind of post sort of completion, if you like, of Brexit, and the fact that as a result there's been quite sort of better valued, or should we say potentially the reason why we're getting that inbound investment from North America is that these sort of there's a sort of undervalued public markets here compared to over in the US. There's been a relatively depressed sterling to US dollars as well, and that has led to, as we can see here, a fairly significant shift in terms of US investment. That's gone up by 20%, and so we are seeing a great deal of activity, or saw a great deal of activity. Now, to try and apply that to this year, clearly it's a very different story. There's clearly very bad things happening on the borders of Europe, and that is impacting a lot of what we're seeing. Where we think things will go is, private equity are still very much involved. Transactions in play are still completing, but what does the pipeline look like? Certainly for the kind of next quarter, and the fact that for a jurisdiction or a business centre like London, there is a huge amount of international capital and international sort of capitalisation, if you like, and I think it's going to be a very sort of different environment, and not just the kind of global issues, but inflationary pressures, supply chain issues, energy issues are all going to stack up in terms of just businesses reassessing where their focus needs to be, which is going to be on costs management in the short term. That's not to say that doesn't come with opportunities, of course, where you've got potentially sort of distressed businesses where private equity may well be able to be moving quickly to get those opportunities, and we'll come back to perhaps some of the types or forms of consideration for those sorts of transactions.
Are you seeing, Simon, any actual geographic resistance, as things unfold in the Ukraine? Is there any concern just over targets that might be geographically closer, to the war zone that is putting people off or having people step back a bit?
I think stepping back is probably the right phrase to use. I mean, clearly, in terms of the, if you like, the sort of political response to what's going on, we've had sanctions across the US, Europe, and the UK. That has obviously impacted certain high-profile individuals, shall we say, and people will be focusing on who's the seller, and that's across real estate. That's across sort of, as I say, sort of consumer retail, where Eastern Europe has been a fairly sort of active area on those kind of areas. So yeah, I think people are being clearly being cautious at the moment. I was going to sort of come back to Neil and just look at some of the conversations we were having just on sort of, if you like, kind of lessons learned, and how, as a potential seller, how you can sort of, if you like, kind of help your process if you are thinking of selling, and any sort of guidance around that as to how you kind of improve your valuations, or actually sort of get, if you like, sort of from a origination perspective, where the kind of quality might be, and where things might end up in 2022, given presumably there's a sort of a limit on pretty good sort of strong earning businesses.
Yeah, I think to your first point, it's just all about preparation, and that goes down a few lanes. Obviously, what's near and dear to my heart is the financial preparation, and where I've seen just deals fall apart, both just from a valuation or just structurally, completely fall down when the seller does not do a good enough job preparing the historical financial information. And just spend the time on really digging in and understanding what a buyer is going to expect to see, what a buyer is going to do, and then there's just some basics of just having a simple grasp of your financial results. As we talking about mid-market, here on this slide, it is very, very common and especially in private equity, mid-market acquisition, to be digging into or be evaluating an acquisition of a company that just simply hasn't ever professionally run its finance and accounting department. And that can lead to real challenges, including just killing the deal, because it's just such a mess and it's too much to, or there's just such a big disparity between the adjusted EBITDA that's floated out there and what the reality is when one just digs in and reconciles financial information. And we're not talking about highly complex stuff. We're just talking about cleaning up and getting things done right in accordance with GAAP, or kind of close enough. So and then also, there are times when we get thrown into processes on the buy side all the time where we're having to go in and we have a big mess we have to come in and clean up, and that again extends timelines, it reduces value, and it can lead to a lot of wasted time and effort on a deal that's just gonna die because somebody, and this is also kind of I say, shame on the investment banker that lets, that puts a number out there that hasn't made sure this has been done as well. And I think that, one of the trends that we have seen and we'll continue to see is that the investment banks are getting, again, they've been burned enough in these processes, and they are forcing their clients to hire somebody like us to come in and do this preparation work so that they, so that they don't have a deal that just dies there, or again, that just the value is just taken down dramatically because what was put out there is just not accurate, just simply not accurate. So I think that's one of my biggest pieces of advice for anybody selling is to make sure to get that done. But then the preparation goes across all lanes. Obviously, the next part of that that goes along with is preparing legally and making sure what sort of legal issues could could impact this transaction for you as seller, or what are the buyers going to be looking at here. And then I think thirdly, it'd be making sure you're getting the right, if you're doing a formal process, you make sure you get the right investment bank that again is going to make sure that you're prepared well, that knows, as we spoke about earlier, knows the buyer universe, is going to bring the right buyers to the table, going to get the right deal done and get a deal done for you.
I think,
and Jeffrey,
one other thing besides that is to have the management team of the seller in the same camp. Now, this may be anecdotal because we had a couple of deals that blew up last year because of this, but to the extent you have a seller and you're going to have senior management or senior executives perform, an ongoing role for the buyer, post-closing, those people have got to be on board. If you wait until the last minute to try to negotiate their employment, their compensation arrangements, their commitment to the deal, all of a sudden they've got leverage, they hold you up. And in one case, at least for us last year, the deal fell apart solely because the seller, did not have his management team in order, and ducks in a row to go forward. So that just on the human capital side, I think that's an important component too.
And actually that sort of kind of brings us on to the next question, Neil, just around lessons learned, but where have you seen acquisitions fail in the past, and are there any sort of trends you can speak to that you're seeing that we can learn from?
Sure, and I think the first one is that they fail, they don't even get done. To my point earlier of not prepared well and unrealistic, is so that's the first one there is, and that's been a consistent trend. I think that's just always been, and I think my trends are not time sensitive. Most of the trends that I would have have nothing to do with the current environment. It's just that this is just why transactions are not successful. And the first is, some of them don't happen. Now, the other side of that is that sometimes the best deal is a deal that's not done for a buyer, at least. So it's not necessarily a fail, but it's a fail on the sellers, at least from the seller's perspective. So so going to the buyer's perspective, what we see most often on where a deal fails, and that can be defined in a variety of ways, but it's just simply even just simply not getting the return that you expected. And what we've seen most often drive that is that it's those post-close activities that are not addressed in the right way, and that can be a platform acquisition where just those first those first 100 days are a fail because you didn't get, even to Jeff's point, maybe the management team didn't hit the ground running. You may have a new management team in there. You might have hired the wrong people. You might not have understood what you were really getting in your diligence process in operations. That is just you're 6 months in and you're way behind the 8 ball on kind of your deal model and what you thought was going to be the for mergers and integrations. The integration process is what generally drives the deal to not be successful or successful. And I think that also can be broken down in a variety of ways, where it could just be the simple metric element of it, of what are the synergies we're going to get out of this that are part of driving the value. Were those not evaluated appropriately pre-acquisition, or was the execution to get to those not done appropriately in the execution of your integration? And there's also just that I would say the more subjective part, less numerical part of the integration of how are you bringing these two organizations together? Are you doing that in a structured and professional manner? We are seeing more and more of our clients take this more seriously and implementing a very rigorous, structured process where they're driving the integration, not just what I'll say. I've seen many organizations in the past just, I'd say, muscle through it. They just kind of throw the teams together and have the leadership just muscle through it and work through and get it done, versus setting up a program, a disciplined program where you have leaders of the program in addition to leaders of the business. And the leaders of the business are steering committee members of the overall program. But you have others that are dedicated to making sure that they're doing that they are doing this integration in the right way. And one of the areas we're seeing much more focus on, and I guess this would be more of a trend, a recent trend, is that we're seeing quite a bit more time and attention and focus on culture. And I think this is not surprising at all, given the past couple of years and where you've seen organizations' approaches and focuses on culture. And I think they're realizing that a lot of organizations are having cultural problems and just broadly having struggles as a corporation because of their culture. And now and then you take that and you bring it in two entities with potentially completely different cultures, and how do you align those, and what strategies and tactics do you put in place to execute that? We're seeing quite a bit more emphasis, understanding that can just blow it up, and seeing people focus on that in the deal making environment right now.
And
Simon, what are you seeing over there on this issue?
Well, actually, my reflections on that, Jeffrey, were the fact that actually it does kind of come down to knowing your markets. It's this sort of tension between going global and not tension. It's remembering that going global also means, and doing cross-border deals also means, you need that local input, that local sort of ecosystem to generate the transactions. Our inbound investors, actually now physically present here in London. Yes, we're seeing more of those corporate finance advisors establish themselves over here and actually get to know the market. In particular, on the UK private wealth side, there's quite a lot of inbound North American deal activity. We've just seen one with RBC acquiring or announcing put a bid in for Brewin Dolphin, which is a significant listed wealth manager. That particular sector is obviously absolutely fundamental to get the culture piece right. It's a professional advisory firm, financial planners, wealth managers. You've got to engage. You've got to win the hearts and minds of those individuals who you actually sort of kind of hold the relationship with the clients. And we've been quite close on that in terms of, if you like, the kind of carrot and stick as to how those conversations need to happen. But we've been involved in processes where the kind of management have been kept well away from the process, and that's just kind of in a way been a bit of a disaster. So yeah, I agree with what Neil's saying. You've got to kind of like look a long way forward to really assess success of a deal.
And I'll say too, we're working on a few cross-border deals right now, actually UK inbound to the US as an example. And what we're seeing is, again, in recognition of this, that they're setting up their clients are setting up UK, North America based integration teams that then kind of roll up into a group team. And I think, again, that's another, so you've got boots on the ground, you've got consultants on the ground, management on the ground, both countries here to work through that global integration there. And again, I think I'd put that out there as a best practice in executing those.
That's a very good time to, I think, move on. I'm just conscious we've just ticked over the 1:30 time. So if we go through onto part 2 and just talk about the actual deal process. On the next slide, you'll just see in some of the elements that we're going to cover in the next 20 or so minutes. What we've sought to do, though, is if you like, sort of put that graphically on the next page. And this is where I sort of hand the cue of the Q&A over to Neil, and he's going to chat through some of the points with Jeffrey and myself.
Yeah, so I think to start this off, guys, given everything we were talking about and kind of the recent trends, just we've got some detail on here, but just stepping back and just looking at the due diligence process, what are just some highlights from your perspective of trends that you've seen over the last, let's call it 15 months now, and what you expect here as we go through 2022?
Yeah, I'm happy to start. I think, especially on the due diligence side, obviously the quality of earnings analysis is important. It goes back, Neil, to what you were saying about, many times you have a seller that has been very successful in creating a business, but maybe not so good in the financial reporting because they haven't had to be. And so I think the Q of E analysis is a big piece of due diligence. I think another thing in this low interest rate environment, think about this. To the extent you are doing leverage deals, you now have 3 constituencies in the due diligence process. You have the buyer, you have the lender, and to the extent you have rep and warranty insurance, you have the insurance underwriter. And so all those people are sharing the same data room, and it's important to make sure that the lender, for example, is on the same page with the buyer, with the equity, with the equity piece of it, in terms of what the due diligence, what the metrics of the due diligence need to be. And I think that is one thing. Many times as lawyers, we will if we are representing the buyer and we're doing a memo to our client, in terms of our due diligence analysis, the lender wants to rely on that, and we generally will provide it to them, but we'll ask for we'll insist on a non-reliance letter. You can see the benefits of our due diligence, but you can't rely on it, to put additional exposure on our firm. So those are a couple of things that that to me are in the mix. Simon?
Yeah, no, thanks, Jeffrey. And I think actually that's really important, isn't it? The kind of who are the stakeholders in a deal, and the fact it's no longer kind of a one dimension to that. My sort of reflections on this were, as you were speaking, was that actually again it's even sort of local transactions are becoming more global in terms of, if you look at who your funders are, could well be an alternative debt fund, possibly US or otherwise, i.e. not UK. Who could your W&I ultimate sort of underwriter be? Well, probably a combination, but again, the US underwriter in there, no doubt, or at least sort of bidding on the policy itself to get that. So I suppose again, it's the sort of cultural aspects as well to be mindful of. Yeah, who is your client, but also how are you sharing your advice? In what way are you reporting on your advice? So my kind of view on this is look at it as a preempt issues on the process. Look at, and we've spent quite a lot of time investing in how we present our due diligence. So it's not just this is lawyer speaking, not just words on a page, but again, it's the kind of graphic use of rather kind of stealing best practice, not stealing, but taking best practice from the accountants. But they do a really good job on the visuals and looking to grade risk. Equally, I suppose it's the fact that given what we're able to do now, just making use of the technology, the fact that we can all jump on a Teams call and can all jump on a Zoom call and actually just kick things around. The accessibility to partners has greatly improved as a result, and so actually you're kind of getting more strategic input into the DD process, and you can make decisions much faster, and that clearly points to being able to be nimble as you can, be agile, so that you can move pretty quickly to actually kind of assess when something comes out, the DD, whether that is a valuation issue, a indemnity issue, is it can it be underwritten? So those are sort of my observations in terms of how we've been running the DD side at the moment.
I don't think I've asked this to any of my attorney colleagues. Everybody that's been involved in M&A is aware of how, given with the unprecedented volume, how the quality of earnings and the due diligence process was just crushed, and firms, just simply didn't have the bandwidth to take on all the mandates that were out there. Especially the last 2 quarters of 21, is absolutely unprecedented. Did in the law firm space, guys, was that similar? Were you seeing larger firms just simply saying, we just don't have capacity to take this on, and or having to delay starts on the legal due diligence side of things, similar to what we saw from the quality of earnings providers?
I think so, and I'd maybe distinguish a little bit between strategic and corporate buyers versus private equity or financial buyers. I think many times if it's a strategic deal and the capacity of somebody to do the Q of E analysis isn't there, if they like it and they understand the industry, they may be willing to accept a little more of that risk because they're familiar with the industry to begin with. And they, even some of the customers, even some of the revenue sources, they may have familiarity with. So I think that's one point of distinction. And the other is, on the PE side, if they can't get that done, I mean, their investors are looking for a rock solid, Q of E analysis before they close a deal. And so, as painful as it is, I think, people are simply, putting the brakes on until that process can be done. That's my thought.
Yeah, and I think that's got a knock-on consequence as well in terms of, well, it goes back to some of the points you were making initially as to bandwidth and bidders becoming more selective on what they're bidding on, because there is only finite capacity, and then also you're sort of looking at, if you're acting for a strategic buyer, or if you are a strategic buyer, what's my leverage as against the kind of private equity buyer who is able to effectively sort of sell management team, equity upside. Well, it is the fact that they know the business. It's the fact that they are able to move quite quickly. It's the fact that they can in-house quite a lot, subject to what we've said about other stakeholders needing to vet the deal as well. So yeah, we have seen instances where there has been that, if you like, kind of capacity crunch on the legal side, and as a result, you've kind of got to be strategic and rather than sort of waiting for a full report, you go in and you take a sort of deep dive into the data room and you look for risk rather than sort of, if you like, kind of just being slightly reactive and just reporting on the DD. You send in your specialist to look at issues.
So with kind of carrying on with the due diligence process, both on the buy and the sell side, if it's different, when is the right time for legal counsel to be brought in to start working on the deal?
Sooner than anybody ever does it. I think there's an awful lot we can do on the pre-planning side. Back to your point, Neil, of just getting the financial house in order, getting the due diligence stuff in order, so you make a better presentation, to a universe of buyers. And it's like, I think we've probably all been through the IPO process. That's really a year-long process, getting a company ready to go, getting the equity, the management equity pieces in place, getting the governance structure in place, making sure the financial reporting is going to be in accordance with, at least GAAP and SEC rules. So, and there's always a tug of war. Nobody wants to pay the lawyers, to do that until there's a deal, to be done. So it's, it's a constant tug of war on that. But there's an awful lot we can do. I think early on in the planning stage to really help increase the value and increase the certainty of the deal getting done.
Yeah, and actually in the mid-market is sort of where it coalesces, in the sense that fast growth companies may not necessarily have the infrastructure to keep up with that growth, and then you've got the private equity acquirers, if you like, sort of slightly having to look at it as a sort of growth capital opportunity rather than a sort of full buyout. So you're if you like, you're one side is coming up and one side is kind of coming down, and therefore, yeah, just around sort of identifying issues and recognizing that there are going to be issues in these fast growth companies, and just actually sort of working through what the consequences of those issues are, and saying, actually, yeah, we take that and we'll put it in our 100-day plan, or we'll put it in our integration strategy to make sure that we solve those. But the key is you're going in eyes open, because from both the seller's perspective and a buyer's perspective, if you're not sort of opening up your DD, and it's not going to, clearly not going to be helpful for seller or buyer.
Yeah, so we've been talking about the competitive environment that we have here. One of the topics that we wanted to talk about was getting to that preferred bidder status. So we're talking about the private equity, private equity clients that are in competitive processes, could be going up against a strategic. What have you guys seen as strategies for becoming that preferred bidder in a competitive process?
I think, again, if you look at bidders who have a more strategic function, or whether it's a bolt-on acquisition of a portfolio company of a PE firm, so you have sort of the same industry, I think a little bit of reputational, hey, we have closed X percent of the deals we have signed an LOI with in the past couple of years. I think saying we will get you representation and warranty insurance, we will pay for that, so you're able to get the sellers comfortable with the fact, yeah, maybe there's an escrow for something post closing, but I've got some certainty around when I'm going to get the rest of my my consideration for this deal. So I think just execution, track record of execution, the little things to the seller, like rep and warranty insurance or some certainty in as to when escrows are going to be released. Those are the kinds of things that I think help.
Yeah, I'd agree with that. I mean, I think there's three elements to the process in there. There's clearly the price, the valuation, secondly the risk, and thirdly the execution element. As you say, Neil, deal certainty, and I think the sort of major development that we're now seeing in the mid-market that perhaps we hadn't seen 3-4 years ago was the warranty and indemnity insurance, and the fact that that's almost becoming a must-have from a seller's perspective. I mean, clearly it's not a product that suits every buyer, and it's something that needs to be priced into a deal, both in terms of what can be insured by that policy, and how you actually then add that onto the premiums, the limits, the exclusions, and so forth. But it's very much enhanced the process and gives that seller assurance on a clean break as possible.
So I want to come back to that, but one thing I would add from my own perspective is, Jeff, you mentioned the kind of the brand of the buyer and and what they've done and how they've gotten deals closed. I would expand that to beyond to what it's like to be owned by that buyer as well. I think that's something I have clients that really pride themselves on. Listen, we people, portfolio, our portfolio, they like being in our portfolio. We take care of them. We're there to make them successful. We're injecting capital there. We're all aligned, and we're a good fund, to be part of. And I think that's another one that I think is, at least I know personal clients that that really use that to their advantage, because it is true.
Yeah.
But going back to warranty indemnity insurance, because this is an evolving topic, not something that 10 years ago that I was hearing much about myself. There could be other people on the webcast here that aren't that familiar with it, guys. Could you go another layer deeper on this, on kind of what it is, why it's important, and what you're seeing in the market today?
Well, it's a tool by which sellers can get some certainty as to what their exposure is going to be. And if you go back sort of to the fundamentals of an acquisition, you have reps and warranties, you have the survival period, and then you want the buyer's going to typically insist on some kind of indemnification, whether if reps and warranties are breached and losses get to be so much, there's always a basket of a minimum amount before the indemnification obligations kick in. The insurance actually provides some certainty as to what the seller's exposure is going to be, and in a particular situation. I think we've seen that come down, in the value at which that makes economic sense to do has come down over the last 3 or 4 years. I think a few years ago, this really needed to be a $60 million plus deal before the costs of the premiums for the insurance made economic sense to do the deal. But that has been coming down. And now, I don't know, Simon, to me, it's maybe a 25, even 20 million is a number, on deal size where the economics make sense to get a policy. But it's something that allows the seller not to have to put a certain amount of the of the sale price at risk, for over a certain period of time as well. It never covers, the fundamental things. You own the company, you have the right to sell it, your tax returns are accurate. Those, fundamental reps typically aren't covered, but it's the other, back, Neil, to your point of lack of sophisticated financial reporting. It's kind of just lack of overall risk management. Think of it that way. And maybe that's a way to look at it. So a great tool to use, and it really, I think, has increased the has helped, is a piece of this huge increase in deal activity that we've seen.
Yeah, and I think for context, I think we just sort of need to remember as well what the purpose of the actual warranties are, which is to kind of support the due diligence and to allow the buyer to really get under the bonnet of the business, i.e., through the disclosure process against the warranties. The idea is for the seller to actually disclose anything that goes to value, risk, or otherwise. So it's not there as a sort of, if you like, kind of post completion or post closing, price adjustment. No one should see it that way. And so taking that sort of risk away and making the due diligence process and the disclosure process really meaningful, but taking the risk away from the seller, it's been a very good product to facilitate, as Jeffrey said, transactions. You're then into discussions around, if you like, what are the exclusions, what are the limitations, what's appropriate for the seller to be on risk for and to continue to be on risk for. I'm just sort of conscious we're clicking up towards the or just after the 10 minutes to mark to the hour. So Neil, is there anything else, sort of any other final points that you would like us to speak to before we see if there's any other questions from
There was actually just one kind of fun question I wanted to ask that kind of because it came up in a board meeting that I was at yesterday. And this goes to the point of we were talking earlier of all the dry powder that's out there. You got the SPACs that are out there and people that have to do deals. And if you have a client that needs or really wants to do deals, has targets assessed, but targets don't want to sell, this question came up was how do you get somebody to sell a company that they don't want to sell? So I thought I'd just, for fun, throw that out there and see how you guys, because I was kind of put on the spot on that one myself. So I thought I'd kind of throw that out there and see how would you guys have responded to that question in a board meeting?
I think I'll direct them to series 3 of Succession and see how that plays out. See how that plays out. Isn't the adage that everyone's got their price, but quite how that works in practice, I don't know.
I think you get into the head of the seller or the selling group, figure out what they want their legacy to be. So you appeal to something other than just financial, assuming if Simon's right, everybody has their price, but if you could kind of sweeten that with elder statesman status or other types of things that give the seller or the selling group some recognition or things that are personally important to them. Typically these are more senior people and so that I think is an element, a non-financial element that you can work.
I think to that point is kind of, solving a problem that they have, they don't realize that a sale would solve. Whether it be a succession issue, transition issue, it could be, family business that you don't have a logical, next in line, all of those. That was the other thing we discussed yesterday as well, is that's, again, they have an issue there they haven't considered that selling may solve for them, that I think then comes along to kind of feeds right into that whole legacy point and the like there. So.
And I guess it's the shape of the deal as well, isn't it? It's not, there's a lot of variety to what a transaction could look like. It's not a necessarily an outright sale. It's, but I think what's you've touched on family businesses, Neil, is what they've recognized over the challenging period of lockdown and COVID is liquidity issues, and the fact that all of their capital is kind of locked up in their one asset. And so actually if there's a deal that can sort of break out some value and some liquidity, but they still retain control, and as Jeffrey said, they still retain the culture and the leadership there, then there's conversations to be had, and I think it's up to advisors to try and sort of facilitate those conversations, to not kind of necessarily have the kind of black and white of a transaction, but there may be some options there. So I think that's a good point. Thank you. Great. So we've just got a couple of minutes left. So Dan, if there are any questions that you think, or a question that you think we could answer in the time available, we'd be very happy to do so.
And we'd add too, there's some stuff in the back of the slide deck, some appendices that may be useful information for people. And if any of you, have questions for us specifically, email us, and we'll respond to everyone. So it's just very happy to do that.
Absolutely, and I would echo that, Jeff. If you do have a question that we don't have time for today, please do send it in. But before we move on to our Q&A section, and I'll try not to put you on the spot as much as Neil did just then. Before we move forward, I just want to say thank you very much to all of you, Jeff, Neil, and Simon. Some really fantastic insights today imparted in such a short space of time. We really do appreciate it. So our first question comes from Ross, and he asks, what are some differences between strategic and private equity buyers in the US, and how are they similar?
Well, and I mean, Neil, weigh in on this too. I think, many times the strategic buyers are looking at, some kind of integration to their existing platform, whether it's vertical or horizontal. And they may be willing to, to live with fewer or less extensive reps and warranties because they know the industry, because they know the business. Where a private equity firm that is maybe a little more of a financial buyer, it has its investor base that it has to answer to. That investor base is typically industry agnostic, but they have confidence in the PE sponsors, which is why they're there. So to me, to me, the differences are the strategic buyer may be willing to live with a little bit less, just because of its knowledge of the industry. I don't know, Neil, what do you think?
Yeah, no, I agree with all of that. I think, they're buying for different reasons generally, especially if you're talking about a platform versus an add-on acquisition in private equity. So there's always that integration case that a strategic has that a private equity may not have. And I think that, to that also that industry understanding, and what I see also as a softer difference is that there are more transactions done for broader strategic reasons versus just purely metric driven financial reasons, which is going to be what private equity is looking at. So even in the due diligence process, the level of granularity and detail of the financial information is different in working for a private equity fund than it would be for working for a strategic acquisition.
Fantastic. Thank you very much. We have a question that I think, Simon, you'll be able to handle. What are the key post-Brexit challenges and opportunities offered by the UK's expanded jurisdictional autonomy?
Well, I think if we like, the sort of opportunities are the fact that, and it's indicated by the transaction data, is that as a result of that decision, that the markets reacted in a certain way, which is in terms of sort of, if you like, our public markets being relatively underweight compared to other international markets, our currency again being relatively underweight. So even if you just sort of see the UK market as a bit of currency arbitrage, there's some on a sort of macro level some advantages. I think sticking with that theme, I think what it has done is it's made investors look at, if you like, the UK as its own market, as well as using it as a sort of platform into Europe. So you are kind of seeing, if you like, sort of quite a lot of activity just as a result of the sort of tech success stories that you have in London, the cultural aspects of that. The challenges, well, it is, and we could sort of talk a lot more about, supply chain issues, accessibility, just in terms of infrastructure and the sort of, friction that's caused. And there has been recent data that's come out on that looks like we are, in terms of our kind of economic growth, going to be impacted by that, with the ABR sort of downgrading our economic growth for the next couple of years. On the legal side, legislation side, yeah, we should become a bit more nimble and a bit more sort of autonomous. But clearly, government and Parliament who writes the legislation has got other priorities at the moment, so that may not be seen for quite a while.
Brilliant. Thank you for that answer, Simon. I'm just looking at the time. I think that we'll keep the next question as the last question, and if you're able to keep your answers short. Are you seeing signs of M&A activity slowing down?
No. Not much.
Brilliant. Thank you
Maybe.
very much.
Plus in brevity.
As we mentioned, if you do have a question or want to get more information, please do reach out to Jeff, Neil, or Simon. Their contact information is on your screen in front of you. We've had some fantastic questions in, so thank you very much for all of those, and thank you very much for being with us today. We really appreciate it, and of course, Jeff, Neil, and Simon, thank you again for your insights. A really fantastic webinar. We hope you can be with us again in the future for a similar webinar on this topic, as it is quite a fascinating subject. But I think that we should end the session there. So I'll thank you all once again. I hope you all have a lovely rest of your day. Goodbye.
Okay. Thanks, everybody.
Thank you.